Hello, ladies and gentlemen, and welcome to the Do More With Your Money show from True Potential, episode 172 today. I'm joined by some of my colleagues from the investment team, Raj, Matt and George. And what we wanted to do today was really look at some of those themes as we approach the halfway point of the year that have been influencing asset markets, how asset markets have trended as a result of that, and try and put some of that into perspective in terms of the decisions that we've been taking within the True Potential portfolios, but also how we've been engaging with our investment partners and the decisions that they've been taking as well within the funds. So maybe if we start to bring some of this to life, certainly it has been a challenging period in terms of it just seems that over the past number of years we've moved from one challenge with markets to another. And I suppose that is part and parcel of investing and why we think about diversification as being so important within our portfolios. But maybe, Matt, one of the things that we all focus on, probably wrongly, is we look at the negatives. Maybe let's turn it around and let's look at some of the more positive things that have occurred really over the first 6 months of the year from a markets and an economic perspective.
Yeah, thanks, Jeff. So to start with, there's a few broad brush things that cover most of the major developed market economies that we can look at. So there's things like the ISM services and PMIs that we're seeing out of economies. Those have been very strong. So the index, when we get readings above 50, that's a sign of those services industries being in expansion. And that's what we're seeing generally across the board in developed markets. So you'll see weakness coming through in manufacturing, although these economies are mostly driven by services. So the fact that those regions are still in expansion is a positive for markets. We're also seeing strong labour markets. So we had out of the UK recently and also the US employment. So we had the NFP in the US coming in at 340,000, well ahead of market expectations. And similar in the UK, that came in at 250,000, once again, well ahead of expectations. To go alongside that as well, we get the wage data out of those regions. So we saw average hourly earnings in the US at 4.3%, healthy number, and in the UK it was closer to 6%. So once again, big healthy numbers coming out of those regions. I think one of the other broad things that we're seeing across developed markets, which has been supportive, which people maybe don't think about as much as well, is just the reaction we've seen in commodity prices. So if we think about where oil is now compared to the start of the year, oil's about 40% down from where it was at the start of the year. Seeing a similar thing in gas prices as well, they're down 50% from the start of the year. So these are real benefits to the consumer.
Yeah, and I suppose there's the interesting factor that you're bringing out. There's a lot of that is about the consumer and consumption, as opposed to what's happening really in the manufacturing sector. And as you said, a lot of people do forget that 60 to 70% of developed economies are really service-based industries, and the strength in employment clearly coming through. So whilst those were the recent numbers, it's been a theme that we've seen over the course of the year as well.
Yeah, it's feeding into so many different economic data prints. The Atlanta Fed, they do a running economic growth rate called the nowcast, and essentially that's, rather than ticking down, that's actually ticked up a little bit if we look through this month. So Q2 economic growth running at about 2.2%, which a lot of it's driven off the fact that the consumer's a lot stronger than anybody had really given credit for.
And I think that's the point, isn't it? As we were entering this year, the expectation was that we would see consumption come under some more pressure than it's had, that unemployment would probably start to move up. Yeah, we haven't. Again, I suppose the challenge of trying to forecast really, isn't it?
I think it's today's number from US retail sales is another example of that consumers are still spending in the economy, keeping those earnings for the companies robust and continue to grow. And I think it just speaks to the strength of the labour market, which continues to provide them with appetite and the purchasing power to go and spend. I think it just reconfirms the strength in the services economy.
And surveys on chief executives across the US is, it's demonstrating that they're still willing to spend, to invest in order to allow businesses to cope with the demand there.
And I suppose one of the things that maybe links that together a little bit is how politics and policy has really helped in the US in terms of the Inflation Reduction Act, and how that has brought a tremendous amount of investment into the US economy, both by US companies but others trying to get part and parcel of that as well, which probably nobody expected. Maybe, I suppose the other side of this is that we've got strength in a number of indicators, but as we've seen, markets have been challenged, particularly when we look at how some sovereign bond markets in particular have fared. And Raj, maybe could you bring to sort of the discussion why that's been the case, and whilst we've got strong and good figures, they're actually could be taken negatively as well from a number of perspectives.
I think this is a great point, because it's as the economic data has continued to surprise on the upside, there's a flip side of it, that inflation, we are still battling with inflation, high level of inflation. Yes, as Matt mentioned, the headline inflation has eased for the prices of energy prices, and also some soft commodities like wheat and oats, and then those commodities have come down. But the core part, which is more related to the wages and the housing, particularly in the US, that is still running at 4 plus, over 4%, 4 plus annualized inflation rate. That is much higher. That makes it the core inflation, which is what matters for the real economy for on a sustainable basis over long term, which is also a focus for the central banks. That is uncomfortably still well above 4-5%, 5 to 6% in certain cases, which is the target. If we take a target, is around 2% stable core inflation for various central banks. We're still running out 2 to 3 times that target. So that probably puts a pressure. What matters for financial assets is how the rates market evolves on the back of that. And that's what we have seen. Even, for example, yesterday we saw Federal Reserve. Yes, they took a pause after the 10th rate hike, consecutive 10 meetings. They have risen their interest rates over the past 15 months or so. They took a pause, but introduced another element to them, which markets are probably not set up for. That was another. Markets were expecting around 25 basis points hike in this cycle more from the Fed in July, but perhaps they have introduced by their forward guidance that dot plot they could go another 50 basis points from here.
I suppose that's one of the things I found quite surprising when I looked at that last night, just thinking about, well, decided to pause at this point, and the usual central bank will pause and we'll see what the data tells us, but the data's already telling them that they've raised their dot plot, so they want to raise rates further. We'll see how actually it plays out, but I think it's just a signaling market, probably perhaps just preparing market just in case if the data turns out to be much stronger than expected, the inflation doesn't come as. And I suppose that's the contrast as well that we've got with the US versus maybe here closer to home in the UK. That as Matt was mentioning, the strength of wages in the data that we saw last week, and indeed the inflation number a couple of weeks ago, has certainly changed the expectations from the Bank of England from a market perspective.
I think that the Bank of England and UK market is particularly acute pressures have we started seeing in last couple of weeks, and that is probably if you rewind back in mid-May or early May, we were talking about rates probably peaking around 4.8 or just under 5% in the UK. Today, as the data has come much stronger, the GDP data is stronger, the labour market continues to, that has probably put a pressure. We're looking at the Bank of England could continue hiking through summer months, which probably takes us closer to 6%, which is quite a marked reshaping of the curve across the board. But on the flip side, we're also seeing that is strengthening sterling. The pound has become stronger. That reduces pressure on the import prices overall. So there's a counterbalance.
So there's a lot of moving parts, I suppose, and that's the challenge with.
But there's two different dynamics. Essentially, what we're seeing is economic data is showing enough resilience to allow central banks to have the space to continue with tighter monetary policy in order to allow them to tackle the challenge which they've got, which is bringing inflation towards target levels.
And I think the difference, sorry Jeff, between what you're seeing in the US with the Federal Reserve and over here with the Bank of England is that, as you were saying, Raj, what we're actually starting to see in the US is those inflation figures start to roll over.
Yeah.
And we're actually starting to see it's not just down to base effects, so larger inflation readings dropping out on the year-on-year comparison. So the Federal Reserve have been very keen on looking at a reading called Core Services Ex Housing, and we've actually seen that peak and start to roll over, which is one of their key indicators of how sticky core inflation was being. We're starting to see that roll over, whereas if contrasted to the latest UK inflation data, we actually saw that tick up higher than last month, but also higher than what market participants had been expecting. So the knock-on impact of that was when that inflation number came through, we saw UK rates, price terminal rates higher by 26 basis points. And then when we got the employment numbers through, which once again was a beat on both the number of employed people, but then also the average hourly earnings, you saw wages increase by 36 basis points. You saw rates, price higher by 36 basis points. So they're the different dynamics that we're starting to see.
And I think that's, is the real contrast, isn't it? That we're starting now to see monetary policy, fiscal policy starting to differentiate between broad areas of the global economy, maybe something that we haven't seen over recent years.
I think that's a great point, because I think it's last year, if 2022 was every financial assets was had one trade, which is rising inflation. Central banks had to continue rising, faster rising in the interest rates, which impacted every asset class, unless you had a dollar. Was the only probably asset class which did well, and certain types of commodities related equities and regions did well. But essentially that trade has started diverging a bit. If you look at this year's performance of it, the growth sensitive sectors like Nasdaq and those consumer related sectors have, despite rates volatility in bond market, we have continued to see these parts of the market continue to edge higher, which was not the case.
And that's also interesting, though, because when we look at data from earnings expectations from analysts, we're actually starting to see in the US those expectations bottom out, and they're not quite picking up just yet, but it looks like we have hit a bottom, whereas when we contrast that with some other regions, such as the UK, we haven't quite hit that bottom yet.
I think maybe, George, to bring you in now and think about that from the perspective of the discussions that we have with our investment partners, there's as just that little bit of conversation has brought to the fore, there's a multitude of factors influencing asset classes and influencing our own thoughts and how we discuss that. But how do you bring that to life with our investment partners and engage with them?
So the engagement's a brilliant part of what we do. We're in a great seat to do that. So we've got 11 global fund manager partners. We speak to them formally once a month. That's a channel where we have all of their analysts and research participants and portfolio managers on the line, and then we speak to them informally. They also provide us with a raft of information and research which they've been doing independently. So that's a great part and the pleasure in terms of what we're doing, because you get a range of different perspectives. We've got some managers, just earlier today speaking to a US based economist just to get their perspective of what they're seeing on the ground. And that, what it means is essentially we as a collective and the information we've got are stronger than each of the component parts when we bring it all together. What we're hearing from our managers and what they're saying, even there's a lot of different aspects at play, and there's still some themes, that we retain and will be familiar with everybody from last month. Duration, that sensitivity to bonds and interest rates is still there in terms of how we've built that in our portfolio. So, bonds are still a favourable asset class for us, and we've seen managers add incrementally. We saw quite a rapid increase from managers coming through the earlier part of this year and even the back end of last year, but still is opportunity there. If we think about just some of the other areas where they're looking at, inflation-linked bonds, in the chance that interest rates come down, but they're coming down because growth's slowing and inflation's still a challenge. That's an asset class which could offer them some support there. From an equity perspective, looking at regions such as Japan has started to emerge. You've got a number of factors at play there. Valuation's been there for some time, and we've always pressed on that one. But more fundamental changes, the stock exchange is essentially saying to companies which have got large amounts of cash, give your return or provide a better return for your investors, or price to book, as they put it more technically, or explain yourself, and that provides an opportunity.
And I suppose within that, there's lots of different views around even those points that you're raising there, that we do have some of our investment partners who are more positive in Japan. There might be those that say, well, it's all about the yen and there's not a structural change going on there. So we're trying to balance those views within the discussions with our partners as well.
Exactly. You've got managers who have got similar views, opposing views, and that's what makes a market, and that's what makes a diversified portfolio. And ultimately, there's some examples of some of the discussions at this point in time, but ultimately we'll vote with our feet, and we'll leverage all of the research and analysis which we've got to inform the decision which we take for clients.
And I think one of the things that has been interesting as well, that has come out of it, is the managers recognising a point even we've been talking about in this room earlier on, about the strength that we're actually seeing in the economic data, but then also the ripple effects that will cause markets to have.
And maybe, Raj, to bring that then to the overall portfolio level, how have we been managing that for our clients, given the points that we've discussed there, the points that George is bringing out in terms of that differences in view, etc., and how that feeds through into how we want to construct the overall portfolio level?
I think that this is interesting. When we started the year, probably most of our managers were a little bit cautiously positioned in general, and that was probably also in line with somewhat of our view as well, that having a cautious position. So, and then even more cautiously positioned in the middle of last year, 2022. If I just talk about equity level, we were sitting at around just above 52.5, or for a balanced portfolio around 52.5% at the equity level. That gradually, as the market have become more stabilized, we bottomed out in October last year. That equity weighting has continued to drift higher. We started the year around 53.5% equity allocation. Today we are sitting at around 54.5%, and the pressure from here on seems like what the teams are coming from our managers. Some of them are trying to shift away from their overly cautious positioning towards still not going full throttle on the full risk on position, but trying to close those underweights they were running, and getting to their long-term strategic asset allocation is the first point of stop for them, it seems like. So the pressure from overall equity and risk positioning is higher. But I think the bigger piece of puzzle is happening within what is happening within equities. It's about which part of equity markets you're exposing yourself. Likes of GA, likes of many other managers we talk to, there's a positive momentum towards Japan. Valuation case, as George mentioned, was always there in the background. You always typically need these few catalysts to come along, and weaker yen is one good example. But we also, two important things that happen in Japan is GDP continues to surprise positively on the upside, and robustness in the manufacturing sector, despite the weakness in overall demand in the global economy, that has continued to provide a boost to, given the cyclical nature of the market, plus also the inflation. If you look at the inflation number in Japan, we are talking about over 4% inflation. That has not been seen in well over 4 decades.
Yeah, I suppose there's the contrast with Japan to many of the other ones. Actually, it's been a story of this period has helped it get inflation out of the deflationary challenges that it faced, to be in a slightly different position than what we're talking about in other regions wanting to lower inflation.
Because it's linked directly to the nominal earnings the companies can earn, and weaker yen also provides that support. So another aspect which is probably George touched upon is the duration or allocation to government bonds have continued to drift higher. Given the yields have become so attractive today, you are being paid to hold and providing a diversification benefits, which was largely absent last year, but has started to come back. The correlation which was historical negative, positive and negative correlation between equities and bonds, that has started to come back, which has been from multi-asset portfolio perspective provides you a good diversification tool.
And I suppose within that, you have certainly seen quite divergent performances within broad equity markets as well. If we think about the Nasdaq, I was just looking before we came down. I think I think it looks as if it's up 28 to 30%, sort of on the year to date level, and you contrast that maybe with the FTSE. And we're maybe 3%, 4% on the year to date. So divergence within it. Equities has been quite significant as well.
I think that is also, if you look at the European market, which was one of the darlings of European markets in general, given there are a lot of expectation being built on the falling energy prices will feed directly into the overall economic growth. That has somewhat weakened with the recent data coming out much weaker than expected. Still not collapsing or cliff edge drop, but still softer expectation, and so that has also meant that European equities, which many of them our managers were presenting as one of the attractive opportunities, that conversation has also eased back as well.
And even within equities, Jeff, even you pick the US there with the Nasdaq. I think even if we look at the sectors below that, we're still seeing a big difference. We're seeing the likes of the tech names, the communication names leading the way, and leaving more cyclicals like energy and material names at the bottom.
I think go ahead, George.
Just to bring Raj's point out, I think it's an important one just for clients. Essentially what we're saying is managers, the way they build portfolios is quite often have a long-term anchor point, which is their North Star through different market environments. And what we've seen, understandably, last year was a number of managers who were more defensively positioned relative to that. And what they've been encouraged by through the economic data, a lot of the aspects which Matt and Raj have touched on there, is to actually reduce some of that defensiveness and move back towards that anchor point as well. So encouragement in terms of the economic data, and earnings in corporations, the resilience of consumers as well, is encouraged change.
And within that, style has been an important factor as well. Growth relative to value has been quite significant, and I think maybe a fair comment would to say that a number of our managers have more of a value bias to how they think about constructing portfolios.
I think that's fair, and that probably feeds into our own portfolio allocation over the past 12 to 18 months. If you like, that value bias has also been very, very supportive for the returns for 2022. Yes, this year has been a little bit challenging from that perspective, given the unexpected performance from some of this narrowness in the market. The rally is so narrow. I
think on that point, the top 7 stocks in the US,
it's a flat market. So I think it tells you that yes, and in that scenario, those value sensitive sectors have lagged. For example, also a FTSE, which is large allocation to energy and value style stocks, have lagged for.
And that probably feeds into how you think about performance of the solution as well.
So I think that is the important, just to put in the context. If the backdrop has been so challenging and so diverse within the performance, divergent performance within various asset classes, and particularly within equities, in that context, I think I was just looking at the numbers before I came in. On an annualized basis, since the launch of our portfolios, balanced portfolios is still up around over 40%. On absolute terms, but if you analyze it, 4.5% return net of all charges for our portfolios, at least portfolio charges. So I think from that perspective, it's a respectable return. And also in this year to date, returns have also bounced back healthily over the past 5 to 6 weeks. We are sitting around, for balanced portfolios, just sitting over 3% return from that. So given the challenges, I think these returns could have been better if you were in those top 10 narrow 5-7 narrowness of the markets. But in that context,
I think maybe that brings out the point of why diversification is something that over the long run is fundamental to what we all believe in, and why that narrowness at times can play out and be a supportive factor at other times. But it really highlights, and maybe some of the things we've been talking about as well, the challenges of trying to forecast, and why that is a real issue at this point in time. And I know, Matt, we were talking earlier today just about the Bank of England and some of their forecasts, how wildly different they've turned out to be.
Yeah, it's been the same case for all central banks. Today you mentioned yesterday, in the past 24 hours, we've had US Federal Reserve and both the European Central Bank going today. They've all altered their own forecasts that they'd put out even 3 months ago.
Yeah.
If we think about coming into the start of 2022 and thinking about what the market was thinking about interest rates for somewhere like the US, market thought by the end of the year interest rates would be 75 basis points. They ended up at 4.5%.
Yeah.
So it just talks, we've mentioned the unexpected resilience of economies given the degree of interest rates, both the speed and the physical amount of hikes that central banks have put through. It's surprised us, it's surprised our managers, but it's also surprised these large institutes.
Yeah, it surprised their forecast, full stop. And we had, I think it was Andrew Bailey when he was speaking the other week, was saying that the Bank of England have stopped using their inflation model because it's given them the wrong answers. But I suppose, like any model, it depends what you put in it and how wide you're going to sort of look.
But as portfolio managers, we're not surprised the surprises, and that's why we build a diversified model. That's why we don't get sucked into these very concentrated aspects of the market which tend to deliver for a short space of time, because that can all be returned. So what we provide is multi-asset portfolios based on fundamental research in terms of each of the asset classes. We use valuation in terms of what are we actually paying for these companies, what are the earnings of these companies and what's the price we're paying for those. And in a bond, likewise, what's the yield that we're getting from it and what's the long term, what can we compare that to long term? And that just gives us a frame of reference as a starting point to then propel off and then look at analyst expectations and caveat each of those that, analysts might get it wrong, and even if you're heading towards those expectations, it's not going to be a straight line.
No.
So for clients, diversified multi-asset solutions the way we believe is the right way to build a solution.
And that's linked to your point earlier that you were making around our managers and that strategic allocation. They've got the North Star. When times are volatile, the data's coming out unexpected, whether it's an upside or downside miss, they've always got that direction to aim in.
And I suppose that brings us to thinking about the importance of that strategic asset allocation framework that our managers use, as you say, George, within multi-asset. That's crucial, and that does give you that frame of reference. At the moment, we're just going through our calls with our managers. That'll lead out to some further analysis from ourselves, and then our key themes. And when will we be thinking about publishing that, do we think?
I think, as you rightly brought up, we're just going through our June round of manager calls. Some interesting views have come out, some divergent views, and evolution to those views. And I think over the next week or so, we will be digesting all of this information, plus from our own thinking, from a collective thinking from on the table, and also from extended team, and try to see once we have this picture, we'll try to see the portfolios, look at the portfolios where. Is there an opportunity for us to upgrade the portfolio quality and generating that excess return and tilting the portfolio ever so slightly, still maintaining the full diversification benefit available to us by these 11 global managers we work for. So I think it's just identifying the themes will come out probably, hopefully, somewhere towards the end of next week, and that will be timely communicated to the clients and to advisors. What our thinking is, what is driving those key themes, and what are the changes. Not only our changes, but also what are the changes our underlying managers have been doing.
And I think one of the key themes that we look to pair with those views and that information that we've got, as you were mentioning earlier, George, are valuations. So we always pair those views with the valuations. You were saying before, George, why are we paying this much for these type of companies or this index? Because ultimately we know as investors that valuations are the ultimate, expected return or the ultimate outcome of your return.
Yeah, and I think just trying to bring it all together, I think we've we've talked about quite a lot of things that have happened, how they've impacted markets, the challenges that they've had. Forecasting is a challenge, as we've certainly seen over the last 6 months. But the one thing that I'm picking up from everybody is really that diversification is very important in that period of challenge, but also through the long term as well, and addressing the goals through a diversified multi-asset solution.
Yeah, absolutely. I think if what we're trying to deliver is the best return we can within clients' appetite for risk, provide the best solution at the best cost that we can. It comes down to diversifying what we do.
I think it's important. It's never going to be a straight line up. It's always going to be challenging, and this is the role of portfolio management team and investment team to try to position the portfolios for foreseeable future, whatever the challenges will be thrown upon us, and trying to ever so slightly navigate the portfolios to generate the best risk-adjusted return for our clients.
Yeah. Okay. Well, hopefully that's brought a little bit of the discussions that we've had as an investment team with our partners over the first 6 months of this year to life for our listeners and viewers. And please do join us in Morning Markets over the coming week, where we'll continue to bring all of those points to the fore. Many thanks.